Futures trading involves substantial risk of loss and may not be suitable for all investors. Good afternoon. This is Oliver Sloup, Blue Line Futures, coming to you from the Chicago Board of Trade. Today is Friday. We made it basically all but the weekend. Friday, November 21st. Wild day in the ag space, particularly the livestock trade, grain markets. It's really been kind of wild all week. Today was relatively tame, all things considered. Before we get into the charts, we'll go over today's closing prices. As mentioned, a bit of a mixed bag. March corn futures, which is now the most actively traded contract, down 1/4 cent today, settling at 437.5 for the week, 6.5 cents lower and about 14 cents off the high of the week. January soybean futures 2.5 cents higher today, settling at 11.25 for the week. That was a whopping 1/2 cent higher, but again, that was 43 cents off of the highs from Tuesday. And then lastly, March Chicago wheat futures down a penny, settling at 5.39 3/4 for the week. That was 1 3/4 cents lower. So you look at those closing prices for the week and you think it was kind of ho-hum. However, there was obviously a lot of movement. We've talked about it earlier in the week. We'll get into it on the charts here shortly. But that's how things ended up. Basically pretty darn close to where we started. And real quick, over on the livestock side of things, that's really where all the excitement was today. We had feeder cattle open limit lower on the back of that headline. 40% tariff being removed from the administration on Brazilian food products, which included beef. So we had January feeders open 307.12, but settled 314.17. That was down 220 on the session. For the week, that contract $6.32 lower. Live cattle, the February contract, which is now the most actively traded contract, 90 cents lower, 214.50. That was about $6.50 off the low. For the week, that contract was $4.75 lower. And then lastly, bringing up the rear, on the snout side, February lean hogs, $2.05 lower today, settling at $77.60. That was $1.67 lower for the week. Now we can kind of jump into these prices. Actually, real quick before we get into the charts, we did have a cattle on feed report this afternoon, the first one since September. That showed on feed at 98%, which is in line with expectations. Placements, 90%, slightly below the average analyst estimate. And marketings, 92%, largely in line with expectations. My quick take on this, largely neutral. I think neutral skews a little bit more on the friendly side because we haven't had any bullish news since the last cattle on feed report, which was back in September. And since then, it's just been a drip of bad news and bearish news. So potentially a neutral report gives a little bit of relief to the market. I guess we'll kind of see how the market digests all that information come Monday. And then screwworm, obviously going to be watched very closely going forward. The USDA did come out with a website that is now live, screwworm.gov. They'll be posting updates apparently on that site. So if you're looking for screwworm news, that's where to find it. Now we can get into the charts. We'll kick things off with the March corn contract, and we talked about it Monday. We talked about it Wednesday. Must hold line in the sand down here near the 50-day moving average, 440 for that March contract, give or take. We failed on there Thursday, which accelerated the selling pressure. I use accelerated very lightly with regards to the corn market because it is the corn market. It's not like the cattle market. It's a little slower mover, especially here recently. Nonetheless, we did see follow-through weakness in the overnight and early morning trade, which took us towards trendline support. 435. You've also got the 100-day moving average, which is not pictured here, coming in at 435. This is kind of a must-hold line in the sand. Talked about this in our Grain Express write-up this morning. Being pivotal support, failure here. And you're looking at a potential retest of these mid-October lows near 425. So 10 cents or so of downside risk if we cannot hold this low. On the upside, bulls really need to get back above this 50-day and this old support pocket. So you're looking at about 440, 442 above there, and you can neutralize some of the bearishness that kicked into gear in the back half of the week. Does that mean that this is going to be a runaway train back to the highs? Probably not. There's a lot of corn out there, so largely I still think this is a consolidation trade with a small tailwind. And again, break and close below here probably neutralizes that bias here in the near term. Nonetheless, that's where we sit into the weekend. January soybeans, that was the big mover really throughout the week. Had the big move higher to start the week, Monday and Tuesday, and then just bled lower on the lack of new news to really get market participants excited. This was a classic buy the rumor, sell the news type of event where we talked about Chinese purchases on Monday, and then we finally got the purchases. The market sold off, and as you had heard, basically finished the week unchanged. We got back into the meat grinder box, which we talked about last week, being this wide pocket here, call it about 1110 to 1137, 1135, which were these highs from the end of October, start of November. Settled right on the 20-day moving average, as you can see, so a little bit in no man's land. This chart doesn't look terrible, but if you go over to the weekly chart, which we've been watching very closely, that looks a little suspect. You've got these big tails that are left here over the last 3 weeks, and that means that people, or the higher prices, are being rejected, and that's really not what you want to see for a sustained bull market. Does that mean the rally's over? No, not necessarily. I'd say just be cautious. Break and close below the low end of this box here. Support 1112 to 1116 is what we outlined in our daily Grain Express. I think that opens the door for potential weakness going forward. Where would that potentially take us? I think you'd be eyeing $11, obviously psychologically significant, but I think more significant would be the original breakout point, which is in the mid 1080. So again, if we can't really hold our ground to start next week's trade, there's some air underneath the chart to that original breakout point, mid 1080s, and below that there is a gap from October 27th in the mid 1060s. So that is the risk to the downside. The upside, obviously, the bulls want to get back out 1135 to the upside. Now, over to the wheat market. Wheat broke below the low end of this wedge, tested and held the 50-day moving average on a closing basis. The chart is not completely garbage. It's certainly weak, but it's not completely garbage. We tested and held 535, which were these lows here at the end of October, the 30th and 31st. Is kind of where we broke out of on the 27th as well. Below that, and you're looking at additional weakness. So wheat, it's tough to get too excited about the wheat market, especially on a longer term basis with where the world stocks are. The chart kind of at a must-hold area, and that's kind of the theme across all these markets: corn, soybeans, and wheat, and just kind of skating by the skin of our teeth into the weekend. See what those levels hold next week. I think that could be key in price action, really, to round out the year potentially. Now, over on the livestock side of things, as mentioned, ugly open. December live cattle futures finally found that 50% retracement, or basically the middle of the range. Got back towards the 200-day midday, and then kind of came off that a little bit. Again, that cattle on feed report, potentially enough neutral-ish to offer some support to next week's trade. We'll see how that happens, or how that shakes out. Potentially the market forgets that we had a cattle on feed report. Wouldn't be too terribly surprised about that, but nonetheless, trend of lower highs, lower lows is intact. On the RSI, really, you're not even that oversold just yet. So again, the trend is lower. The cash market, you'd think, would be able to offer some support. We kind of thought that over the last couple of days. That clearly wasn't the case. The tariff news with regards to Brazilian beef, we thought that was probably largely baked into the cake. Clearly that was not the case, although that headline had been talked about for the last couple of weeks. So we'll see what next week brings. That cash trade softening up a little bit, and hopefully that can find its footing and help the futures price stabilize as well. Then over on the feeder cattle side of things, ugly open, below that 50% retracement, below the 200-day moving average, pop back off those lows. But again, you're going to see how next week trades. This market is not for the faint of heart. Really wouldn't recommend using futures to trade the feeder cattle market, especially if you are a tourist, just kind of seeing something move and think that you got to be in. Don't start with the feeder cattle market. Start with something a little bit more tame. And lastly, we'll just wrap things up. It looks like we're running out of time. April lean hogs sharply lower today's trade. New lows for the move. Not great on the chart. It looked like the last couple of days were going to get us out of the dungeon, get back above that 50% retracement. However, the market had other ideas, so I'm kind of sit on our hands and wait for a better setup technically in the April lean hog market come next week. So that is how things shook out today and what we're looking at ahead of the weekend. If you have any questions at all, don't hesitate to reach out. We're ready, willing, and able to answer questions. All the charts on the Blue Line Edge trading platform is a free complimentary platform to our clients, desktop and mobile. We also put together daily research in-house. Goes right to your inbox, covers a wide variety of markets. So if you're interested in that, head over to bluelinefutures.com. And I'll leave it at that. Have a great weekend. Remember, trading futures and options involves substantial risk of loss and is not suitable for all investors.